three small points I will highlight that, and towards ensuring as well as preserving the financial system stability, the Reserve Bank has been taking many definitive steps. Today I would like to walk you all through a few of those enabling steps by the Reserve Bank. Number one is a consultative approach to regulations. Globally and especially in India, regulatory approaches have evolved to become more consultative, incorporating the feedback to develop balanced and effective regulations. The establishment of Regulations Review Authority 2.0 in 2021 is a testament to RBI's commitment to streamline regulatory instructions, reduce compliance burden, and eliminate obsolete requirements, thus fostering a more efficient regulatory environment. Having served as the chair of the advisory group representing the industry at that time, I can personally attest to the regulators' responsiveness and sensitivity of the industry's concerns. The implementation of various recommendations of RRA 2.0, coupled with the tireless efforts of the various interdepartmental groups within Reserve Bank of India, has already led to the issuance of several harmonized, consolidated and updated master directions, as well as withdrawal of over 1,000 circulars, apart from doing away with many regulatory and supervisory returns that have become redundant. These measures have significantly reduced the compliance burden on the regulated entities. The second is pushing for a good governance. History is replete with examples, both in India and abroad, as to how apparently successful business ventures quickly folded up due to poor governance and excessive greed. Therefore, the Reserve Bank has taken up this as one of its focus areas to create awareness as well as to ensure adherence to good corporate governance practices. We are having more frequent and direct engagement with boards and top management of regulated entities as well as self-regulatory organizations. Through these dialogues, we share our concerns and priorities and also strive to understand the challenges faced by the industry so that the appropriate regulatory measures can be taken up. The third is instilling a culture of compliance. An essential element for sustaining longevity of financial institutions is that a culture of compliance should prevail across the institution. The recent direct engagement with the heads of assurance functions as well as CFOs and auditors by Reserve Bank is testimony to our efforts to strengthen the internal defense mechanisms within our financial institutions. The independence and professional conduct of assurance functionaries, strongly backed by the board and top management, is essential to preserve this culture. I am glad to share with you that these initiatives have been very well received, and I would like to thank the heads of our financial institutions for prioritizing these initiatives in their organizations. So having spent some time on how we have played an enabling role, I would like to shift to highlight how industry is cyclical, including finance. The financial industry, like any other sector, experiences cycles, and it is currently riding a high wave, as all of you would agree. Therefore, this is the right time to strengthen our institutions, enhancing their financial and operational resilience, and ensuring the long-term stability of our financial system. For those wondering why now, I emphasize that taking decisive action now, even if it means swallowing some bitter pills, is crucial to ensuring our financial institutions remain strong enough to support the national goal of becoming a developed economy by 2047. It's not only important to simplify, harmonize, and rationalize or modernize, but also to strengthen the regulatory and supervisory framework. Recent drafts on expected credit loss, project finance, and liquidity coverage ratio exemplify this approach, aiming to reflect the needs of the industry while seeking to step up financial strength and stability. And the third part of my speech I thought I would cover as to how RBI has been in the forefront of innovation. The RBI has undertaken several initiatives to support the development of digital public infrastructure and establish robust institutional frameworks complemented by various policy measures aimed at enhancing the financial sector. In 2019, the RBI introduced the regulatory sandbox framework to provide a controlled environment for testing new financial products, services, or business models with real customers under the regulatory oversight. This initiative facilitates collaboration among regulators, innovators, and financial service providers to assess the benefits and risks of emerging technologies. Since its inception, 5 cohorts of the sandbox have evaluated various ideas, with some of them proving to be feasible. To address situations where a product or service might fall under multiple financial sector regulators, an interoperable regulatory sandbox mechanism was also introduced in 2022. Complementing these efforts, the RBI has also organized global hackathons under the Harbinger initiative, which not only rewards winners generously but also provides stipends to shortlisted teams to support the prototyping of their solutions. The third edition, Harbinger 2024, themed Innovation for Transformation, invites solutions aimed at achieving zero financial frauds and creating Divyang-friendly technologies. In 2021, RBI established the Reserve Bank Innovation Hub, which has been instrumental in advancing digital solutions, such as fully digital and streamlined delivery of Kisan Credit Card farm loans. Last year, it launched the pilot on public tech platform, now more famously renamed as ULI, designed to facilitate frictionless credit by enabling seamless flow of digital information to all lenders. This platform features an open architecture and open application programming interface, allowing financial sector participants in a plug-and-play model. So the fourth part of my speech is I thought I would take to some of the commentaries that we hear. Having covered extensively on some of the initiatives that showcases Reserve Bank as an enabler, I now would like to deal with some commentary of regulatory disruption that plays out in the market, thankfully only by a few, but it is still necessary for us to examine this. One such narrative is that the regulator's actions may curb innovation or intrude excessively into business operations. There is also a feeling that regulators must be more supportive of risk-taking. What needs to be understood is that while businesses can be adventurous and inclined to take on greater risks in pursuit of their goals, their profits, and investor returns, the regulators have the responsibility to protect depositor and customer interest and preserve the financial stability. The role of the regulator is to establish guardrails or a balanced framework that encourages innovation while ensuring that risks are managed prudently. For example, the fintech platforms often provide customers with a seamless, efficient experience. By leveraging digital public infrastructure, these platforms can reach a wider customer base, including those who previously had limited access to financial services, thereby advancing financial inclusion and empowering the underserved communities. They help in reducing the cost of customer acquisition as well as transaction cost. Digitalization also allows banks and NBFCs to leverage data for greater insights into their customers' requirements and behavior, which can be used for developing bespoke products, apart from facilitating better risk management and compliance. Reserve Bank has been playing an encouraging role all through such initiatives. However, this digital shift also introduces risks that must be properly identified, mitigated, and managed to maintain a stable and secure financial ecosystem. The integration of disparate entities delivering a digital product often results in complex structures with overlapping responsibilities. In many instances, the actual lender may not even be visible to the borrower, despite regulatory requirements for full transparency. While fintech platforms drive innovation and revenues, credit and operational risks, along with consequent losses, if any, still primarily rest with the regulated lenders who collaborate with these platforms. This can create a disconnect between the service providers and those bearing the risks, leading to potential vulnerabilities for the individual lenders as well as to the financial system. For instance, while loan sanctioning and disbursement have become increasingly digital, effective collection and recovery still require a feet on street and an empathetic approach. Many fintech platforms operate on a business model that involves extending small value loans to customers, oftentimes with poor credit profiles. Unfortunately, this is often followed by aggressive recovery tactics, such as invading customers' privacy by accessing their contacts and personal data. These practices can seriously damage the reputation of the regulated lenders associated with these platforms. According to RBI regulations on outsourcing, even though a regulated entity may rely on third parties to perform certain activities, it remains ultimately accountable for the actions of its outsourced agents. Another narrative I would like to address today is the perception that supervisors are overly eager to impose business restrictions, sometimes being portrayed as trigger-happy. This misconception creates an impression that regulators are constantly looking for opportunities to clamp down on financial entities. We are sometimes asked by the media, some of them who are here, who is next, implying that supervisory actions are routine in nature. In reality, the decision to impose business restrictions is never taken easily. Strong supervisory actions are brought in only after careful on-site examinations, off-site data analysis, and extensive engagement with the regulated entities concerned for remediation, oftentimes stretching into several months. Our primary goal is to ensure the stability and integrity of the financial system and not to hinder business operations. Out of over 150 banks, over 9,000 non-banking financial companies, about 1,500 UCBs, and various other entities that we supervise, stringent actions have been taken only in a handful of cases. That too, the most outlier in each category has been called out for such punitive actions so that it has a demonstrative effect on the rest of the industry. These measures are not about penalizing, but rather about protecting the interests of depositors, customers, and the broader financial system. Despite these efforts, it's disheartening at times to see innovative misinterpretation or intelligent interpretation of regulations. A recent case in point is that of peer-to-peer, the P2P lending regulations. The regulations as originally conceived, I'm sure some of you here would certainly know, the regulations as originally conceived envisage the platforms to function like online marketplaces connecting lenders with borrowers, with no credit risk borne by the platform and no commingling or retention of funds by them. However, the supervisory findings over the last 1 year revealed that some of these platforms adopted practices which were violative of both letter and spirit of the regulations. Instructions issued earlier this month on P2P lenders are nothing new, but are merely responding to the egregious violations observed in some cases. However, it is being presented in some quarters as if these new regulations will kill the industry. On the contrary, the differentiated licensing and light touch regulations that were granted to such entities are intended to help them set up a unique platform and not mimic banks and NBFCs that are more robustly capitalized and more stringently regulated. So in conclusion, despite occasional brickbats, the regulatory frameworks have been adopting a consultative approach which has helped shape a resilient financial sector. Over the past few decades, the Indian banking sector has navigated many challenges, including the Asian financial crisis, the global financial crisis, and most recently the COVID-19 pandemic. Each time, the Indian financial sector has emerged stronger. about which we are all very proud of, thanks not only to the efforts and adaptability of the industry, but also to the prudence and foresight of the regulatory framework. All of us are partners in this journey towards realizing the vision of Viksit Bharat 2047. However, dreams cannot be built on weak foundations, which is why it is the regulator's responsibility to set up both enablers as well as guardrails that will ensure that we reach our destination safely, securely, and keep going.
Thank you very much, Mr. Swaminathan, for giving us this overarching picture and where the banking sector and the regulator wants the banking sector to head. I must tell you that you spoke of brickbats. I have not heard of so many. When we ask bankers and NBFCs for any reaction to the Reserve Bank, it's usually very, very cordial and positive. Of course, they check with us, is it on the record or off the record? So, the response also depends on that. But I must say, jokes apart, that the fact that, the first point you made, that, unintrusive supervision, removing outdated regulations and filings, that's something that's come in for very high praise. I mean, there are people who say that all the Reserve Bank asks us now is, just give us your login and we will check whether the processes are there. Extremely, that's come in for a lot of praise. I'm going to wear my journalist hat and ask you questions, which were not covered. One of the big talking points, of course, is that, deposits are becoming very, very hard to come by. You've been a commercial banker, now a central banker. What's your view? Is this structural? Because if you take if you ask people under 40 over here, I don't think any of them even have an FD. So has something structurally changed about deposits?
Yeah, thank you, Lata, for having me here. It's a pleasure to be participating in this event. It's a good question to start with. You said deposits are hard to come by. Maybe I would like to slightly put it differently, because if you look at the numbers on a year-on-year basis, deposits are still growing at about 11-12%. It's not that that there is a contraction or there is a degrowth. Deposits are still coming at about 11-12%.
They're growing slower than loans.
Yeah.
That's it.
So the only context, as you rightly said, is when seen in the context of the rate of growth of credit, it seemed to be not keeping pace. So that's the context in which the discussion comes up. What we need to also see is that these are cyclical, and we have seen times in which the deposits grew almost twice as that of credit. We had a couple of years of that nature as well. We had 8-9 quarters when deposit was outpacing and banks were had to find ways to manage the liquidity that was flowing in. And today you have a situation where the demand for credit is more, and aided by digital lending, the money has become mobile. So the growth is going good. But coming to the second part of your question, is structurally something different. But I think this is something which we'll have to understand, that this is a generational shift.
Yes.
Today, the younger generation have more options and are also willing to take a bit of a risk in terms of variety as well as chasing better returns. So deposits becoming a choice of senior citizen is not something which we should be surprised of. This is a part of the evolution. So whether it is debt funds or equity funds or index funds or investing in properties or gold, there are multiple options for financial savings today. And this will be typically cyclical, and I'm sure that people will find the best way to manage their savings. Okay. So as long as that savings do take place in some form or the other, we should not be much worried. And one last line, again, to deal with the structural part, as a regulator, what we have done is, in the last couple of MPC statements, we have just sensitized the lenders that if this gap is allowed to continue for longer, it may create a structural liquidity risk for some of the banks or financial entities who are already in a high CD ratio. That's the part, and I'm sure that they are competent enough to see what is emerging in front of them and let them handle.
Okay, then that's the follow-up. You have, like you said, in the past, two policies warned, or rather mentioned, highlighted, that credit deposit cannot be cannot have such a gap. Are you satisfied with the progress?
See, there is no golden number or an ideal number that we can chase in these matters. So whether we are satisfied or not satisfied is difficult to
the
respond
delta, the
to.
trend.
But if you look at the trend, you are right. The incremental CD ratio is certainly moderated. That is one part. And we are also seeing the deposits are also growing, and we've seen banks augmenting their product offerings. Banks are also talking about improving their service quality so that they place themselves as a choice to the generation which would like to explore various options.
So you don't see yourself taking any steps to encourage. You think that the trend is already in the right
Absolutely no steps required at this point in time in our view, because we have told the boards to strategize, recalibrate, basis their scale and complexity. So it is left to the commercial wisdom of the entities rather than a regulatory prescription.
You know, this understanding that youngsters are saving through capital markets and not through FDs, many public finance economists point out that anyway, even the capital market money is in the banking system. So, what exactly has changed in that case? Instead of FD, it is in current account, is it?
Yeah, I don't think anything has changed, because money will finally have to find its place. It will be back in the banking. If not in retail deposits, it could be in deposits that comes through the markets. So that way the money has the same velocity, and it has got to move within the corridor which is allowed unless money is remitted abroad.
Yes.
Other than that, I'm sure that the money...
leaks
So the economists, what they are saying is fine. I think when you have two economists, you will have three opinions. So I think I'm not competent to make a fourth opinion on that.
Okay. No, the reason why I'm asking you is that if the money is going only as current account, from FD, it's a larger part of the money probably is going as current account. Would you, a part of the reason why the slowness has come is, slowness in deposits has come, is probably because the Reserve Bank created less reserve money in the previous year, for the simple reason that at that time you all were chasing inflation. So do you think it is cyclical? Do you think it's a matter of time? And if it is a matter of time, by when do you think loans will, go below deposits or deposits?
I think so. I'm not I'm not in a position to respond to that particular analogy. Maybe you reserve this question for the MPC.
Okay, then the other thing that you raised even in your speech, the markets, the financial sector is in a high point. But in this high point, you have been pointing out that unsecured loans are a matter of worry for you. MFIs are a matter of worry for you. How much has the worry abated, or do you think it is still a matter of worry?
Again, I would like to be categorically clear that whatever financial parameters that we are tracking, at this point in time, certainly there is no worry or a concern, because if you look at the slippages, if you look at the credit cards, if you look at the GNPA, NNPA, or the SMA, as we call it, whether it is 30 plus DPD or 60 plus DPD, none of these numbers are showing any trend that is likely to become a worry or concern. They all seem to be behaving fine. But if you compare them with the situation a year ago, probably there is a slight uptick. Anticipating this, we took some preemptive measures already, as you would know, in November last year. We saw certain outlier growth in certain segments where we thought there could be a possible risk build-up. On those segments, we called out and added certain risk weight, which was a very clear signaling device. And if you look at the last 2-3 quarters, those segments are moderated. So I think that the measure that was taken, which was preemptive, has had its effect. So we see a moderation at this point in time. And as regards the little bit uptick that we see in some of these parameters, while it is not yet a matter of concern, again, in the last MPC statement, if you would recall, we have requested the lenders to strengthen their underwriting standards and also step up on their collection and recovery process so that we don't end up in a situation where there are elevated risks. I think that must be good enough.
Would you say we have peaked in terms of the high, and now we should be prepared for the financial high cycle to start down cycling a bit?
No, but I think we wish that the party continues.
Okay. Thank you very much, sir. On that very positive note, thank you very much for joining us.